Hey guys, Dave Keller here with Market Misbehavior. I love to ask interviewees what their one chart would be. And that is, if you had one chart, just one chart, besides a regular chart of the S&P 500, as a way to understand the broad market environment, what would it be right now and why? So here is my one chart for today. Okay, so today's one chart is the New York FANG Plus Index, or essentially the FANG stocks, the FANMAG stocks, the FANGMAN, FANMAG, FANG, whatever we want to call them. But basically this list of mega cap technology, consumer discretionary communication services stocks that have been seen as leadership, justifiably so for a number of months, if not years, essentially leading up to the fourth quarter of last year. If you look at the chart of the FANG Plus Index, this is an index run by the New York Stock Exchange. It's $NYFANG on StockCharts. And it's not just the FANG stocks, Facebook, Amazon, Netflix, Google, Apple. Microsoft is sort of the other, FANMAG is what I would probably call them, and Alphabet or Google. But it also includes some other things like, Twitter, I believe, is in here. Some of the Chinese internet names are in there. So it's sort of FANG and FANG-like stocks in this index. And essentially, if you look, the index came off going into the March low, bottomed out a little bit before the March 23rd market low, and since then really took off to the upside. The relative strength, this is the New York FANG Plus Index relative to the S&P 500. You can see that the line's in a pretty steady uptrend for much of 2020. And that consistent up move is what, led me and many others to talk about this narrow leadership in the markets where the, breadth was okay, but it was really a relatively small number of mega cap stocks at times that was really driving the markets forward. And so technology, consumer, as sectors did very well and outperformed because of the leadership of these mega cap names. There's a lot of reasons why those names have done well for so long. I would argue a big part of it is just herding by institutional investors. The more big benchmark names like that, like a Facebook or an Apple, the more that kind of stock outperforms, the more that you have to own it if you're an institutional money manager, because it's such a big weight in your benchmark. If you don't own that name and it does well, it's really difficult to outperform your benchmark, which is your main goal as an institutional money manager. Do better than a passive product or better than the S&P 500. So there are a lot of reasons why that group, this group has done very well. That all changed though, really with the September market peak as stocks kind of peaked out and the FANG Plus Index peaked out. You can see that for the period right after that, it was sort of a sideways period. It hit a peak in September, retested it in October and November, but didn't push higher. You can see the relative strength really flattened out from being an uptrend through much of the year, and then essentially being sideways, really through the middle end of December. And even since then, the relative strength really has not impressed. Now, there's a number of reasons for that. Part of it is a catch up by a lot of other groups. So as stocks in general topped out, this is in the fourth quarter. Into the fourth quarter is when you saw things like energy stocks and financial stocks come from a period of relative weakness, relative underperformance to outperformance and relative strength. And this is where they started to emerge as leadership. This is where the FANG stocks started to underperform those other groups. And if you look at the ratio of something like Microsoft versus something like JP Morgan, that line overall is going up until the last couple months when it starts to roll over and Microsoft is underperforming a big bank like JP Morgan. And that's part of that. Part of that is rising interest rates. It's a rotation from growth to value, a rotation from mega cap stocks to small and mid cap names. But overall, you've seen the prices go down. So here's the catch, and this is why it's our one chart for today. What now, right? What do we do now that we're in 2021? We've seen energy stocks do well, perform well out of the gates. Year to date, financials have done pretty well also. But what about these big tech consumer names, these FANMAG names? So if you look, very few of them are really in what I would call uptrends. Most of them, if not all of them, are in consolidation phases. I think of the market and market direction in one of three directions. It can be an accumulation phase of higher highs and higher lows. It can be a distribution phase of lower lows and lower highs, or it can be a consolidation phase where the highs and the lows are relatively even. And overall, if you try to draw one arrow to summarize the broad direction in the market, well, in this stock, for example, on Facebook for the last 4 months, you'd probably draw just this horizontal arrow, maybe skewing down a little bit because overall you're seeing lower lows, right, and lower highs. But overall, we're certainly not going up, and we're certainly not going meaningfully lower. We're sort of going sideways. So the kicker, and this is the FANG Plus Index, the FANG relative strength, and then below there we have Facebook, Apple, Netflix, Microsoft, Amazon, and Google, or Alphabet, and that's the acronym FANMAG that I keep saying. So overall, the reason why this came top of mind right now is just this leadership theme. When we talk about the growth in energy and financials, sort of the late cyclicals, when we talk about the improvement in the value trade over the growth trade, that does not do well for this basket of stocks, which are large companies that are not in the value space, they're more in the growth space. You can see by the prices, as I mentioned, all of them are in consolidation phases, but most of them are sort of in the middle of a big rectangle. So if you look at Netflix, for example, you can draw a rectangle with the top of it around 560, 570. You can put the lower end here around 460, and you can summarize the last 6 months of price movement with a big rectangle here, showing a consistent resistance level or a ceiling in the market and a consistent support level, a floor in the market. The reason why Netflix is top of mind is because they just reported earnings after the close today here on Tuesday, January 19th. They surprised the upside after hours. You know, the stock closed below 502. It's up in the aftermarket trading to around 560, just above that, which very interestingly puts it right at the upper end of that rectangle. So my general thesis here overall is these stocks are in a consolidation phase. That consolidation phase is over if and when they can start breaking to new highs. And what's really easy about a period of consolidation, remember John Bollinger talking with him about Bollinger Bands and looking at volatility and range-bound markets. And his comment was, a period of lower volatility where you have consolidation precedes a period of greater volatility, meaning when you have established an equilibrium, basically Netflix is rotating around 5.520 a share. At some point, it's going to break above 560 or it's going to break below 460. At some point, it's not going to go sideways forever. At some point, the buyers take control and push it to new highs, or the buyers are exhausted and the sellers take control and push it below the swing low below 460 into new lows below the 200-day moving average. And whichever way that breaks, I would assume that momentum, the price momentum, will continue the direction of the breakout. So you're really in wait and see mode. So it's interesting, first off, to be watching Netflix through the remainder of this week. Does it breach 560, break to the upside and follow through, suggesting buyers have taken control and push the stock to new highs? Or do we continue to trade around and consolidate in these levels, at which point, if that's the case, I would argue avoiding these names and focusing more on things like financials and energy that have done well in the last couple months would probably continue to do well. In terms of all of these, besides Netflix, which is going to rotate back to the upper end of its support, what other themes? 3 other things I would point out. With Facebook, it is just bouncing off its 200-day moving average, which also lines up beautifully with its low from back here in September. So support levels, a confluence of support, which means support that is tested by a couple different indicators, right? Price support from the low here, moving average support bouncing off the 200-day. That also lines up with the resistance level here when it accelerated to the upside out of the March lows. It hit a peak around 240, and that is the level that we're rotating around now. So that's a really meaningful price level for the stock. If it holds that, that would be encouraging. If it breaks that, that would be very concerning. And that's why that's another chart to watch. Apple is maybe one of the most constructive in terms of becoming a pattern of higher highs and higher lows. It has huge overhead resistance around 135 to 138. This is the peak from early September, also the peak from late December. It needs to get above there to really start to look more constructive, but you can see that the lows have gotten successively higher. So every time the stock pulls back, we're chipping away and making further and further gains. That's another one. The third one would be Google or Alphabet. And out of all of these, again, if you look at the rally into the September peak, the pullback to the 200-day, then a break above the 1700 level, and now retesting that from above. That idea that resistance becomes support is common in charting and overall sets up pretty well for potential future gains. It would need to get above 1850, get above that December peak to validate higher potential for further upside. So this FANMAG group, or the FANG stocks, I think are key to watch right now. Leadership has been elsewhere. They've not impressed on a relative basis. Having said that, we're entering into earnings, and Netflix is the first of these 6 stocks to report earnings. They have surprised to the upside. The stock's up about 10% in the after hours, which is going to put it to the upper end of this consolidation zone. So I think that's one chart to see if it's able to push through 560 and push to new highs. After that, there are a number of other stocks that are starting to get a little more constructive. Facebook potentially bouncing off support, Apple potentially establishing a new higher low, and Alphabet bouncing off of support at 1700 and rotating back to retest the highs. The story of the FANMAG stocks or the FANG stocks through the first half of this year, I think, will be the story of whether these stocks are able to hold support and break out and show accumulation, broader accumulation, and a new accumulation phase, or do they fail and continue to stagnate while other stocks do better? I hope you found this video helpful. Please check out some of the other videos on our Market Misbehavior channel. Hit like, subscribe, leave us a comment. Which of these 6 stocks in the FANMAG group do you see as most likely to outperform in the next coming months or so? Let's see what we all think. From everyone here at Market Misbehavior, wish you well. Be safe. We'll talk to you again soon.